Why do some businesses struggle while capital concentrates in a few enterprises? The modern business landscape reveals a stark reality. While a select few enterprises corporations thrive uncontested, problem holds a disproportionate share of global wealth relative to the gross domestic product (GDP). Opportunities for smaller businesses shrink. The economic system favors entities that can expand, invest, and dominate market share, while emerging businesses find themselves at a disadvantage. This isn't just a coincidence. It's the natural consequence of consumer behavior, investment trends, and corporate influence. As money flows toward well-established chains, competitors lose access to the financial oxygen necessary for survival. 2. Strategy versus capital accessibility. One might argue that business strategy determines success. However, in reality, nearly all businesses launch with a structured plan, regardless of their financial limitations. The true challenge isn't strategy. It's access to capital and the ability to navigate restrictive financial ecosystems. Large corporations benefit from investor confidence. Markets favor established players, making capital accumulation easier. Political leverage. Corporate giants often influence regulations that benefit their operations. Economies of scale, bulk production, and distribution cut costs, outpricing smaller competitors. Smaller businesses, lacking such advantages, find themselves fighting an uphill battle where survival isn't determined by innovation alone, but by the sheer ability to sustain operations in a system that favors existing power structures. 3. Corporate versus individual capital flow. Major corporations like Tesla, real estate firms, and conglomerates operate on a completely different financial cycle. Their capital moves through acquisitions, stock market investments, government incentives, and R&D expenditures, often taking months or years to realize profit. In contrast, small businesses rely on immediate transactions, selling products or services daily, reinvesting earnings, and sustaining cash flow in real time. This difference in capital circulation speed places smaller businesses at an inherent disadvantage, while corporate giants absorb wealth at a pace that prevents competitors from emerging. 4. The economic cycle disruption. When small businesses collapse, the broader economy suffers. Fewer job opportunities, reduced market competition, stagnation in innovation, economic power concentrated in fewer hands. Governments attempt to curb this by offering tax incentives, financial assistance, and anti-monopoly regulations. But whether these efforts truly balance the scales remains an open debate. 5. Can this trend be disrupted? The question remains, is there a way to decentralize capital concentration, or is this cycle inevitable? Some potential solutions include encouraging entrepreneurship through easier access to prevent corporate overreach, shifting consumer behavior to support local businesses instead of corporations. However, systemic change requires more than just policies. It demands a cultural shift where individuals